typically impose price ceiling when they believe that the equilibrium price in the market is too high and undesirable. Example, we consumers cannot afford a necessity. Good example of market where maximum price could be imposed are food and housing. Food is a necessity, and in developing countries, some people might be unable to afford the quantities required for survival. Hence, governments could impose price ceiling on the certain foods. Same with the housing market. If equilibrium rent charge is such that a lot of people are homeless, government might be set a maximum price in the housing market. Mostly happens in developing countries. Price ceiling or maximum price is the highest possible price that producers are allowed to charge consumers for the good, service produced, provided set by the government. It must be set below the equilibrium price to have any effect. If the maximum price is set above the equilibrium price, then it will have no effect. If the maximum price is set below the equilibrium price, it will cause a shortage. Demand will be greater than supply. Maximum price involves the government making a normative judgment that the market clearing price is too high and need to be reduced. The government may impose a maximum price for a variety of reasons. The good is essential for daily living. Without a maximum price, some people may be unable to afford the good. By reducing the price, it can help reduce relative poverty. Monopoly exploitation. If firms have monopoly power, they can charge high price to consumers, higher than the marginal cost of production and higher than in a competitive market. A maximum price can be a way of reducing monopoly price and increase allocative efficiency. A monopoly sets price of PM and makes supernormal profit. A max price reduces the market price close to the equilibrium in a free market. Inelastic supply. If supply is very inelastic, then a maximum price will not reduce the supply of the good. Therefore, there will be no fall in the quantity supplied. Resource allocation. If rents were very high, it may cause investors to concentrate on building new houses and ignoring other aspects of the economy. However, an excess of house building could contribute to a bubble in home building, which leaves the market vulnerable to a correction in price. A maximum price limits the resource flowing to house and enables a more balanced economy. Maximum price for train tickets. With monopoly power, train companies could increase the peak tickets, but governments may impose a maximum price or maximum price increase on firms to keep tickets affordable, even if it leads to overcrowding. Maximum price for rent. Governments have tried different types of rent control to keeping the cost of renting below a certain level. Maximum price for food. In some developing economies, there are maximum price for certain foodstuffs to keep them affordable. Ticket price. Football clubs keeping price well below the market clearing equilibrium. This kind of maximum price is voluntary, chosen and not set by the government. But for important occasions, the government could decide to set maximum price.
Okay, so what are tax? Tax are mandatory contribution levied on individual or corporation by a government entity, whether local, regional or national. Tax revenue finance government activity including public work and service such as road and school or programs such as social security and Medicare. Okay, so why do we need to pay the tax? Tax are primary source of revenue for most government. Among other things, this money is spent to improve and maintain public infrastructure, including the road we travel on and public service, such as a school, emergency service, and welfare programs. So, who need to pay the tax? The taxpayer will depend on the type of tax and associate regulation for that tax. For example, federal income tax legislation usually only pertains to people who have earned a certain amount of income or just gross income. Corporate tax limit to company that have performed business in a specific area or are incorporated to do business within a specific country. Each tax is handled differently and there are often exceptions and qualifications for who the tax pertains to. Okay, so tax delinquency. Every type of tax has a different due date or reporting requirement. Some are collecting immediately at the time of a transaction or leading up to a transaction like a sales tax or tariff. Others are on a fixed recurring schedule with a due date repeating on the specific date or specific day or months. Combinations such as a property tax being due the first day of April. The due date for similar types of tax will vary across governing bodies, such as different countries will have different property tax due date. Upon failure to remit the appropriate amount of a tax to the taxing authorities, various penalty may be incurred. Regarding the various tax mentioned above, tax penalty may include: first, a penalty assessment resulting in a one-time fee or charge. Second, an interest assessment resulting in an escalating penalty based on the duration of the delinquency. Third, a lien placed on underlying asset in the event the delinquent party should be unable to satisfy their debts. Fourth, the denial of access or service for transaction-related tax, such as tariff. Fifth, a seizure of company property or placement of a lien on the company property for business-related tax. Okay, so there are some types of tax that have in Malaysia, such as corporate income tax, individual tax, sale and service tax, we also known as SST, withholding tax, real property gains tax, and stamp duty. Later, we will go one by one. Okay, first we have corporate income tax. Okay, so what is corporate income tax? Corporate income tax in Malaysia is a direct tax paid to the government imposed on both resident and non-resident companies that have received income from Malaysia. The corporate income tax rate varies based on the type of company. Next, we also have withholding tax. So, what is withholding tax in Malaysia? According to the Inland Revenue Board of Malaysia, withholding tax is an amount withheld by the party making payment which is payee on income earned by a non-resident which is payee and paid to the Inland Revenue Board of Malaysia. The payer is an individual or body carrying on business in Malaysia and is required to withhold tax on payment for service rendered or other payment made under any agreement for the use of movable property and paid to the non-resident. Payee is a non-resident individual or body who receives the payment. Besides, also have real property gains tax. What is a real property gains tax? Real property gains tax is a tax on chargeable gains that homeowner and business have to pay when selling their property in Malaysia. If property is sold with a loss, you are not required to pay real property gains tax. So, when need you to pay real property gains tax? Once you have disposed your property, you must submit the real property gains tax return within 60 days of the disposal date. If you fail to meet the deadline, you will be subject to an additional 10% penalty. Last but not least, we have stamp duty. Stamp duty is a tax imposed on legal document and is divided into two groups. The two groups or category of stamp duty in Malaysia are: first one is fixed duty, which is it charged at a set price and includes stamp for individual police or copies. Second one is ad valorem duties. Its variable cost based on the value of the transaction that the legal document represents. Documents subject to stamp duty include real property transfer, share transfer, business transfer, rental or lease, security, sealing or annuity, general stamping, company duty payment, repayment, and last, appeal.
I will continue about the problem of maximum price. First problem is shortage. The maximum price distorts the market and leads to disequilibrium. The demand is greater than supply, meaning many consumers will be unable to get the product at all. Cheap rent also are not good if it leaves many people homeless. So the second reason is encourage black market. It creates incentive to develop a black market where people illegally trade the good. The next reason is queues. Queues is encourage people to spend longer and longer in queues before it runs out. The next one is time spent in queuing represent a significant cost in terms of time. The last reason is the market will become less profitable for firms. It is because it leads to less investment and also decreased supply in the long term. That's all from me for the problem of maximum price.